The Kurv ETF, KYLD, the weekly income fund, showing a 23% yield. Is this good for retirement or is it a yield trap? I'm going to explain it all. Welcome back to the channel. I'm Doug, the retirement guy. We're going to break down Kurv's ETF, KYLD. This one came across from one of our Patreon supporters and really asked me, is this really a good number, 23% for a weekly? I hear a lot of negative stuff on weeklies, and normally I don't cover weeklies on this channel, but so many people have been asking. So I normally do this on our other channel, but when they brought it up and said, hey, I got curves, we've talked about it, I'd like to get your opinion on it. And we pretty much will do whatever we can for our Patreon people. So let's break this down and let's get going with it. Grab your mug, put your favorite beverage in, sit back, and let's learn about KYLD. Important disclaimer, this content is for educational and entertainment purposes only. This is not financial advice. Past performances do not guarantee future results. Hey everyone, before we get too deep into this, I gotta just say thank you so much for supporting this channel. And how do you support this channel? Well, it's so many different ways that you can do this because we are an unbiased channel. We do not take sponsorships. We don't do anything other than give you what I see as the hardcore facts and give you the information the way I would present it, my parents would present it, my grandparents would present it. Well, one way if you want to help support it is that Retirement Made Easy, living on dividends, coffee mugs. We have the 11 ouncer, we have the 15 ouncer. You can use the QR code or the link down below. This little bit, you will be shocked at how much this supports the channel, helps us keep putting out these type of videos. Along with that, if you guys have not noticed, and some of you definitely have noticed, our big 40-ounce travel mug, this thing's been flying off the shelf. Thank you so much for the support. These things are phenomenal. Again, another great way to support the channel with the Retirement Made Easy mugs. So let's get into today's KYLD ETF review. It's a 23% and it's weekly paying income, which has got a lot of people we're interested in. And like I said, our Patreon person contacted us when we were doing a little review of their portfolio. And he says, I'm really wanting to get into this. I like the weekly idea. But I know it's a little bit newer fund. I just don't know if this is a good weekly income or this is going to end up being a yield trap. Well, I told him straight out, when you see the 23.7% distribution and paying weekly, that's a great number. And I've tried to explain this on the channel so many different times because that number is just a number. You got to know what the total return is. So yield is just a math number, okay? And I try to explain this to everybody. Yield is just a math number that tells you nothing by itself. But the financial health of the fund, you got to dig deeper. You got to know what the income is, the growth is, and then the magic one is the total return. Now, if you give me one, basically number 3, the total return, and one or the other two, I can pretty much tell you what the other one actually represents. So the question is, a strong retirement income or a high yield fund, that needs extra caution. So this is my magic, I call it the golden rule, is you look at your income, you look at that big yield, 23%, and yes, you put it on question because you want to know what your total return actually works out to be. So let's dive into, first off, what is KYLD? Well, this is Kurv's High Income ETF. It's an actively managed fund designed to pursue high income. Now, this fund came out October 30th of 2025. So this is not even a year old as of yet. So that's always on guard with me. Now, it does break my 6-month to 12-month period. So I gave him credit for that. The track record, less than a full year of operating history. And there's no index ETF. This does not simply track the S&P 500, the NASDAQ 100, the Russell 2000, or any single stock covered call index. So it's a unique kind of piece that we're talking about. Now, KYLD is closer to an actively managed high income portfolio that a traditional index ETF would be like. Okay, but it does not track those indexes. Now, the primary objective, bottom line, they write it straight out, and I put it in big bold print. High income. Their portfolio is built this way. Their option contracts are built this way. The stocks, the treasury bills that they're putting into, the managers can select the stocks, the ETFs, the exchange traded products. They can do the option contracts, short-term fixed incomes. The holdings are based on market conditions. So another positive to this is that the managers have full operation to do what they want. They're not dialed into, a select index. They can do stocks, ETFs, and so on. They are based on what's happening in the marketplace. So how does KYLD generate that big income? Well, the fund combines traditional portfolio income with active option premiums. So the bottom line is they do own some stocks that pay dividends. They get the treasury interest from money sitting, I call, on the sidelines, and then they go out and do covered calls get the option premiums. So with that active income portfolio, the covered calls, the synthetic stock exposure, and the active call and put call spreads generates the income. So the trade-off is income today with higher option premiums can boost that weekly cash distribution, but has less upside. The ongoing downside, call options may limit those gains while the volatility in the marketplace is holding and can still fall. The option income can support distributions, but the exchange part of tomorrow's upside is where you're struggling with. And this is why weeklies have always had this problem, is they're paying out every week and they got to regenerate their income again to pay out that dividend. They only have basically 5 days to do that. So it's very, very tough. And especially in today's markets that either we're not seeing the growth of the thing, we're not seeing as much volatility in select pieces. It gets hard to generate those distributions and generate those dividends. And most of your stocks are going to be paid monthly. So that's another key factor to it. So let's take a look at what does KYLD actually own. Now, this is a treasury-backed active management portfolio. Now, it is tilted towards volatility growth themes. So 29% of it is short-term U.S. Treasury bills. High growth stocks and sector ETFs will generate another section. Okay, so they're getting into the major positions is AMD. They're going to get into Robinhood, Broadcom, Shopify, Reddit. There's a lot of pieces we're seeing in this thing is we're seeing a lot of semiconductors and AI packages. We're seeing precious metals and the miners of those precious metals. We're seeing aerospace and nuclear, social, health tech. So we do see a broad combination across the base of all of these. Now we get to the yield and the weekly distributions. Now, weekly cash flow can help with retirement budgeting, but the payout can change week in, week out. So it's not consistent, nor is it guaranteed. Now, the reported distribution rate right now is of July 22nd of 2026. They're forecasting out a 23.70% distribution. Now, that's not the total return figure. That is their yield number they're talking about. So what we always say when the retirement budgeting is that you have your money coming in and you got to pay those monthly bills. And yes, getting that weekly paycheck is fun, but is it enough to cover your weekly bills? Now this one here pays about an average about 10 cents per week. Okay, that would give you about $5.20 per share over the 52 weeks, or if you have 100 shares, about $520. Now, the last payment is basically analyzed for illustration purposes only. Okay, so we're just kind of giving the idea what the fund has been doing because we don't have a full 12 months to work from. Now, this is what I call the huge yield gap. The headline distribution rate is not the same fund's underlying investment income. Now, what do I mean by that? Well, the bottom line is this huge yield. We don't know what the growth has been. We don't know what the NAV has been. We don't know how it's flowing out, what the money's coming through. So they advertise at 23.70%, and they're collecting a 30-day SEC yield, which is primarily from those treasury bills, about 0.45%. So the numbers, are really, they sound great. Now, the option-related cash flow can support the distributions. The payouts may include return of capital, not only dividends and interest. It may be return of capital. And I'm going to say that now, which I'll explain a little bit more detail about. But when you have a weekly fund and you see return of capital, that's another warning sign that if used improperly, you're getting your own money back. But most companies use return of capital as a tax advantage. And immediately when I see weekly and return of capital, my warning signs go up and say, whoa, 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 dig deeper, don't jump. The 23.70 figure assumes that the latest payments continue for that whole year. So we don't know. This is why I always say you wait 6 to 12 months. You do your research. The less than 12 months, you better be doing your deep dive researches into this. Over 12 months, you have a little bit of past history. But remember, past history does never guarantee future results. So you always got to be doing some research. Let's take a look at the growth and the NAV performance. Okay, yield is the cash distributions to the shareholders. Growth is what's happening to the fund. When this thing launched, it launched out at $25. Okay, that was the NAV number that it came into. We have seen a 14.96% decline in the NAV. This is where the worry comes in. Now, 14.96% basically works out to be basically about a $3.75 difference. This is considerably high. So you're down to about $21.26 as of July 22nd of close of business. So a falling NAV doesn't automatically mean overall losses, but the yield alone cannot tell the whole story. So now we have our 23% yield. We have a drop off of 14.96% in the NAV. So there is no growth in this fund. It has declined. Even as it does, the distributions have continued. The NAV has still declined. So you hear a lot of people talk about, NAV erosion. Oh my God, NAV erosion. Now, first off, everyone will tell you this is NAV erosion. Well, realistically, it is and it's not. I want to share with you. In NAV erosion is what over a long period of time you've seen a major loss. Now, this one here, I'm going to say, hey, look we have a few months under our belt. It has dropped off and it is dropping fairly steady. But we also have to look at, is it market conditions? Is it market strategies? Is there something in the marketplace that it's just adjusting? Now, most new funds will always start at a certain number, they'll adjust down and then recover to their flat spot and then work from that point. And I believe what's happening here is it's finding its natural bottom. It's finding its natural working spot and then growing from that point. Now, that's just my perception of what I've seen. Now, I am on the point of this is some NAV erosion. It is cutting into this, but can the yield make up for what we've lost? This is why we take a look at total returns. This is the more complete measurement that you want to deal with. Income payments can offset a declining NAV, but total return shows the full results. So remember, they're forecasting 23%. Now, we don't have a full market analysis on this yet, but since inception through June 30th of 2026, the total return off of this is 12.27%. So your 23% that you're talking about is really 12 or 11 percentage points off the total return. So when we take a look at the growth, I would tell you straight out, we're probably looking at that negative 12% or 11% growth with a 12% positive. Now, that 23.7% you have to remember is the forecasted all the way out. But realistically, the number is coming right now about 21 percentage points. So we're still right in that, really, that's why I use these numbers. They're pretty in the same line across the board. Your total return for the year to date so far, 12.52. So when you look at this, I would stop you immediately and say you don't have a 23% yield fund. You have a 12% total return fund. And that's what you would take your investments from. So basically, if you had $10,000 invested in this on the day one, including distributions and how the fund is handled, you actually would have $11,227. So you gained 12%. You see how that total return makes the big difference. So is this a yield trap? It's a yield advertising trap. It's a 23% advertiser with a realistically 12% return. So I just want to make sure you're clarified with that. Now we got to talk taxes. And this is where we come into, as I said earlier, they're going to use return of capital. Now, return of capital, as I've done this many a times, and we have videos on this, I would highly recommend. If you don't understand ROC, search our videos, pull it right up. I'll tell you, it'll explain everything for you. But basic knowledge of ROC is this. Your starting tax basis, what you basically purchased the fund, that share for, is $25. Okay? The return of capital, well, so they're going to say we gave you $4 in distributions and we classify as 100% ROC. That means your tax basis of your cost of that fund on paper is $21. So it's not elimination of taxes, it's a kick the can down the road. ROC is generally a tax deferred, not tax free. So many people think it's tax free. It's tax deferred. When your basis reaches zero, the further ROCs will be taxable at capital gains. Now, hopefully you've held the stock for long term, so it's long term capital gains. But you get the idea of how they're doing the ROC. Now, nowhere did this say that they can't return your capital as your own actual capital because distributions couldn't be made this month to keep their distribution numbers up. So you got to make sure you're tracking the assets under management. You got to make sure you're tracking how this thing's done. And the other thing to always remember too, this return of capital saying about 98% right now, they're saying 98% is ROC. That is an estimate. And not until they report the 1099 DIV does the tax reporting actually tell you how much actual ROC was actually part of this. So your tax side of it looks great that they're kicking the can down, but they could come back and finally not make the last kick and keep it and say, yep, we only did 20% ROC, 10% ROC. So nothing happens until you get that 1099 form, so remember that. Now, if this is in an IRA or a Roth IRA type program, the annual distribution classification is less important and the account rules actually apply more. So this is something I would highly recommend in an IRA or a Roth. If you put in taxable brokerage firm, you better get a little more knowledge of how accurate they are with their ROC program. Now, expenses. This is another one. If you're going to hold this for long periods of time, this fund is telling us there will have a net expense ratio of 1.00%. So that's almost the same price as you're being charged by a financial advisor at 1%. The gross ratio is about 1.16. Now, this has been waived until October 31st, and they do that for a reason. They want to get people on board. They want to get people to invest into the program, and they're doing a good job of that. But what does that number really represent? So many people I hear, well, you didn't do the expense reports onto it. Well, I don't know if a lot of people understand it, because If you're taking 1%, okay, and you're putting it into a fund, if you invested $1,000, it's going to cost you $10 a year. $10,000 invested, $100, $50,000, $500, $100,000, $1,000 a year cost for the fund. Now, the fund at the 23%, the 12% total return number are having these numbers calculated into it. But this is your holding cost for long periods of time. So if you held this for 10 years, you can add 0 to any one of these numbers and say how much money that they created, they made to do this work for you. 1%, extremely high. I just put point blank. 1% is high for a long-term holding cost of this. Broader index ETFs offer a far lower discount. They offer a lot less expense than what this one is. So this is definitely, in my book, a negativity. Now, the major risks of this fund, well, of course, is going to be that limited track record. We don't have a full year of history, what's going on. The volatile holdings, growth, momentum, technology, energy, mining, there's some large swings back and forth in their holdings. Their option trade-offs is that blocking that ceiling. The upside is protected, so you don't see the growth coming out of it, and we've seen a lot of NAV, and that's one thing to worry about. When you see covered calls and they're seeing the NAV drop off, the recovery is going to take so much longer in a loss than it will take if you didn't have it all covered. And then distributions. Weekly payouts fall roughly from 16 cents to 10 cents per share. It is a negative. I'm going to tell you this right off. It is a negative because you can't budget for this. You don't know what it's going to be. You have to play defensive onto it. But it also tells me that the fund is paying out more about what their distributions are versus trying to use the ROC to keep up a big number. But still, that is a major risk factor because it's a gamble, and that's what weeklies are about. Weeklies are a little bit more of a gamble across the board. That's why I started this channel here for monthlies, and I did the other one for weeklies, so that we could just dial into each one properly. But because of a Patreon, I'm doing what we're doing here. So high yield does not remove portfolio risk. I want to make sure you guys understand that. You have to watch the NAV. You have to watch your total returns on a regular basis. This is why I don't always suggest you have weeklies in your retirement portfolio. So who may want to own KYLD? Well, the potential fit is people who want that weekly retirement income. I'm not going to argue with you. I would love to have weekly income as a retiree. It's like being back working where you're getting a paycheck. Okay? It accepts meaningful market volatility, understands the option-based strategies, and then is comfortable with the ROC as a tax tracking treatment. It accepts active management and the higher fees. Now, the mismatch is the need for maximum principal stability, okay? Which basically means if you're not willing to gamble what you have, then you don't need to be part of this fund. If you want predictable dividend growth or income across the board, definitely this is not a fund for you. This prefers the simple index fund exposure. Again, they're not going to do that. They're picking what they think is going to happen in the near future. If you can't tolerate distribution cuts, if you can't handle what's it coming through, this again, not a fund for you. And would it make the entire portfolio? No, you're not going to retire just on KYLD because of 23% yield that you think you're getting. You're not going to do that. At best, this is a satellite play in an income area, and it's always less than 5% total in the risk area. So if you're considering KYLDs as a satellite option position, not a portfolio foundation, you're going to need to pair this up with other well-established income funds, dividend growth ETFs, bonds, treasuries, however you build your growth side of it or your income side of it. This is only a satellite, which is a little helper to maybe boost you a little bit, But you got to remember the true number right now is 12%. Will that change? Potentially. Can it go down? Most definitely. Can it go up? There's a chance and possibility that it could. But right now, for what I see as a retirement fit, if you want to make this fit your portfolio, it has to be a satellite, but you better give me a better reason than just I need weekly income or I like weeklies. There's too many moving parts of this one that just don't fit for a retirement made easy type application. And that's what I work for. So my final scorecard is this. Yes, I do give this a B minus. I'm starting to try to do some grading, kind of give you guys some new things here. But the strong income appeal, but that limited history and the structural trade-offs can be resistant. The high income frequency, guys, yes. Weekly distributions and can support retirement budgets. I give it an A. I do give weeklies an A for the idea that you're getting a check on a weekly basis. The high line yield, that 23.7 is compelling. And yeah, it got an A. But you have to understand that investment yield is not total return. It's not the number to work from. The growth and the NAV stability is where it really dropped off for me, is that the NAV is below its $25 starting level, even though the portfolio has grown to some decent numbers and they've done what they've done to try to hold it. It's just still, you're dropping off. There is some NAV erosion into this, and they got to clean that up. Total return, a B plus. It's a positive since inception, but based on a very, very, very short history. Tax purposes using the return of capital, again, I got to see a full 12 months. Their system works like most others. I give it a B side of it. But their expenses, where I really is the other big drop off, that C minus, is that 1%. It's just way too expensive for a particular fund if you're going to hold for long periods. I know there's a lot of work with weeklies. I know there's a lot of work with picking and actually having someone manage it. But overall, 1% for this, way too high for my book, way too expensive. I don't believe that should be that high. So overall, I'm being generous. I'm being very generous, telling you that this is a B minus. It's really a potential and suitable for a limited satellite position. And then I'm going to say that's for very aggressive income people. This is not a portfolio for down foundations. This is not for investors seeking stability. And I'm going to put it straight out, guys. The retirement made easy. I'm your guy for retirement made easy, living on dividends. I've been doing it for 10 years. This is not in my portfolio. This would not be in my portfolio. It's not one I would suggest or recommend in any way, shape, or form, even though I don't recommend things from this channel. But anything I build with this would not be into it. Is it something to put on the board, the dartboard, and look at occasionally? Sure. We can always look, but we're just not buying. So the bottom line, guys, as I said, yield creates the headline. Total return creates the retirement. Okay, hopefully you understand that and learn from that. Is total return is what we looked at. And total return here showed you a 23% fund is actually only a 12% fund. Is this a yield trap? To a point. It's an advertising piece. So hopefully this helped you guys out. Like I said, this is not for retirement made easy, living on dividends. This is not one it's going to be in my portfolios. So hopefully you understand what we're trying to do. Hey guys, also don't forget about our 40-ounce tumblers. I know a lot of you have. We do have a little backlog onto it, but we have gotten the majority of them out, and we do have another load coming in and getting them right out immediately. So don't be hesitant. Order yours now, and we'll get them shipped to you.